Hey students, welcome to the video on financial accounting at your fingertips. This is the 17th video on partnership accounts. In this video, we are discussing dissolution and insolvency of partnership firm. So, there are various modes of dissolution of a firm that we already discussed also. First, dissolution by agreement. That means a firm is dissolved when all the partners agree that it should be dissolved. Second, dissolution on happening of contingency. That is expiry of term or duration of partnership, completion of one adventure, death of a partner, adjudication of a partner. Then dissolution by notice of partnership at will. If the partnership is based on a partnership at will, then dissolution can be happened by giving a notice by any partner is willingness to dissolve the firm. So giving notice to other partner is intention to dissolve the partnership firm. Then there is compulsory dissolution, that is dissolution at operation of law. That means all except one become insolvent. All of you know partnership is the relationship between two or more persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Here, when all but one partner become insolvent, all except one become insolvent, then it is compulsorily dissolved. Or the partnership is involved in illegal business. As per the Partnership Act, the partnership cannot involve in illegal activities. And when the number of partners exceeds 100, so maximum number of partners in case of any partnership is 100. If at any cost it exceeds the number of partners exceeds 100, then partnership firm will be compulsorily dissolved. Then last but not the least, dissolution by court at the suit of a partner, or court may order discontinuation of a firm. Then in this video we will mainly focus on insolvency of all partners. The partners firm dissolved due to insolvency of all partners. In this video, we will discuss the theory and problem. First, where outside liability are not transferred to relation account. In case of insolvency of all partners, outside liability are not transferred to relation account. What are the procedures? Accounting procedures are stated. First, transfer sundry assets except cash in hand, cash at bank, debit balance of profit loss or accumulated losses shown in the asset side of balance sheet, which is known as fictitious asset. Then on the relation of asset, the relation account is to be credited. That means all outside liability are considered separately in one account, that is sundry liabilities. Then all the sundry assets excluding those, suppose debit balance of capital or current accounts or profit accumulated losses, it will not be taken into account, and cash and bank balance. Then on realization of assets, cash and bank account debited to realization account. Then for realization expenses, we have to debit the realization account, credit cash in hand, cash at bank account. Then you remember only fully secured liability to be debited to realization account. If one liability is given to the firm on mortgage of assets and it will be realized to the full extent, then it will only be taken into realization account. Otherwise, all the liability will be transferred to sundry liabilities account. For unsecured liability, separate account is prepared named sundry liability. Amount brought in by partner from his private estate to be debited to cash or bank account, credited to realization account. Suppose any partner has brought in cash from his private estate, then cash or bank account debited to realization account. So cash account is prepared in order to calculate the amount available for unsecured creditor, that is outside liabilities, and balance in unsecured liability. Suppose there is some liability which cannot be paid by the partner due to their insolvency, then it will be transferred to deficiency account. Then capital account, after all entries are closed, by transfer their balance to deficiency account. Finally, deficient account will be tallied and also cash account will be balanced. Then we will solve one problem based on those insolvency of all partners. So we will prepare one realization account, then cash at bank account, capital accounts, liabilities account, sundry liabilities accounts. So first we will start with one realization account. Particulars amount. So this is left hand side is debit side, right hand side credit side. So this is particulars. This is amount. So amount we can write, this is the symbol, then particulars, then amount, this is the symbol. So here, first all of you know, all assets excluding cash and debit balance of profit and loss account given in asset side will be transferred to realization account. So to realization account debited to sundry assets. Sundry assets. So sundry assets includes all assets excluding cash in hand, cash at bank and profit loss account. So stock 1,56,300. Stock 1,56,300. Then debtor 47,200. Debtors 47,200. Then furniture 95,300. Furniture 95,300. So total comes to total of sundry asset is then 800. Then $2,98,800. Then no liability will be taken. Then here it is given, following the balance sheet of Ashok, Avinash and Binoy as on 31st March 2023 of a firm having profit sharing ratio equally. That means they are sharing the profit sharing ratio equally and it is given to close the books of the firm. And the additional information given, the firm was dissolved due to insolvency of all partners, stock sold for 99,000, 60,000 collected, furniture fetched 50,000, then cash received from debtor 41,000, realization expenses 2,200. Then nothing recovered from two partners, that is Avinash and Binoy, only 6,000 recovered from the private asset of Ashok. That is the question. So we will do two realization account, two cash account or cash or bank account, that is hyphen realization expenses. It is 2200. Then assets are sold. So write by cash. We can write cash at bank accounts or only bank account we can write. Cash at bank or only bank you can write. Then it is realized how much? By here first asset is stock. Stock 99,000. So value was 1,56,300, but realized only 99,000. On dissolution of firm, when all partners become insolvent, stock of the business worth 1,56,300 now sold for 99,000. Then furniture 50,000. Furniture 50,000. Then debtor 41,000. Debtor oath was 47,200. Only amount realized 41,000. 6,200 is bad debt. So debtors 41,000. So total assets realized amount is 000. Then 1,90,000. So there is realization of loss. There is realization loss. So debit total is 3,01,000. So by loss on realization debited to capital account. By loss on realization debited to or adjusted from, whatever right, adjusted from capital account of partners. Capital account of partners. So they are sharing equally, means divided by 3. Ashok, then Avinash, then Binay. Here there is loss of, so 3,01,000 means 1,11,000. So divided by 3 means 37,000 each. So Ashok 37,000. Then here Avinash capital debited 37,000. Binash capital debited 37,000. Then capital realization account is over. Then we prepare capital account, cash accounts. Then capital account of partners. On the date of dissolution, partners' capital account will be closed. So this is 3 partners. 1, 2, 3. Then 1. So this is left hand side is debit side, right hand side credit side. Then this is particulars. Then capital accounts of Ashok, here Ashok. Then Avinash, then Binay. Ashok, Avinash, Binay. Here particulars Ashok, Avinash, then Binay. Then here particulars. So capital account will be opening balance by balance brought down. His Ashok capital is 80,000. Then here it is Avinash capital is 60,000. Then Binoy capital is 10,000. Then here one profit loss is 1,20,000. This is having, it is assets. That means it will close. So capital account debited to profit loss account. They are equal partner. So 40,000 each. So capital account debited to profit and loss account. Amount is 40,000, 40,000, then 40,000. Then there is loss. Capital account debited to Ashok, Avinash, Binay. To realization account hyphen loss. To realization account hyphen loss. So amount is here 37,000, here 37,000, then 37,000. Here one thing done. The amount 6,000 recovered from private estate of Ashok. So by bank accounts or cash account, whatever you like. Ashok is 6,000. He has given 6,000. Then we have to prepare one cash account. Then after preparing cash account, we will prepare deficiency accounts. So cash account, here that is debit side, credit side. This is opening balance of cash. So we write to balance brought down. So cash amount was 31,200 at the beginning. Then cash realized on sale of assets 1,90,000. So to realization accounts hyphen sales proceeds of assets, sales proceeds of assets or sundry assets. How much? 1,90,000. Then realization expenses, that is bank account debit, realization to bank or cash, cash by realization, that is expenses. You can write cash account or cash at bank account. Suppose it is cash at bank account. By realization, that is expenses 2,200. 6,000 received from capital account of Ashok. So bank or cash account debited to Ashok's capital account. 6,000 Ashok's capital account. This is 6,000. Then we will prepare one loan account. Then sundry creditor account. Then deficiency account. First regarding sundry creditors. So we will open account by balance brought down. Amount was 2 lakh. So it will be transferred to sundry liabilities account. Sundry liabilities account. So 2 lakh done. Then we will prepare one loan account. Under loan account, it is secured by furniture 1 lakh, but furniture is sold for 50,000 is given. So loan account, here under loan we will write by balance brought down. Loan amount was 1 lakh. Only furniture sold for, that is 50,000, or a loan paid for 50,000. So to cash account, that is 50,000. So difference will be transferred to sundry liabilities account. Sundry liabilities is 50,000. So loan account over. So we will prepare now sundry liabilities and deficiency account. So sundry liabilities accounts. So under sundry liability, the entry is sundry creditor to sundry liability 2 lakh. So by sundry creditors 2 lakhs. Then loan to, here also loan to cash. So cash by loan repayment on sale of furniture, that is 50,000. Then loan to sundry liability balance amount 50,000 by sundry liabilities, by loan to sundry liability by loan 50,000. Here it is given 70% is recovered, that is payment by to 70%. Here to cash account or to bank account, whatever you write, to bank account 70% of, that is here 2,50,000. Then realize 70% means 1,75,000. Then rest will transfer to deficiency account. So deficiency is 75,000, 30%, that is 75,000 is deficiency. So we will prepare one deficiency account. Deficiency account. So on deficiency, sundry liability to deficiency, deficiency by sundry liabilities, by sundry liabilities, amount is 75,000. So here cash by sundry liability to bank or bank by sundry liabilities, amount is 1,75,000. Here we have to see how much is the deficiency. Here also credit is 86,000, debit 77,000. So 9,000 is surplus. So whatever may be, whether surplus or deficiency, it will be transferred to deficiency account, because all of you know that in case of partnership, not only their amount invested in the partnership firm is at stake, but also their personal property will be attached. After paying their personal liability, whatever left on their personal realization of personal asset, that will be utilized here. Here 9,000 will go to deficiency on behalf of Ashok. So Ashok will pay 99,000, that is 86,000 total. Then here Ashok to deficiency, deficiency by Ashok, the amount is 9,000. Here both having debit balance, here 77,000, 77,000, Ashok and Avinash and Binoy, nothing is realized from the private estate. So 77,000, 77,000. So deficiency of Avinash by deficiency account. Its deficiency is 17,000, but here Binoy deficiency 67,000. 1767. Account is closed. Drop to parallel to close the account. So deficiency to Avinash, amount is 17,000. Then to Binoy, amount is 67,000. So total is 84,000. So deficiency account is closed. Then cash will also be tallied. Cash will also be tallied. So we have prepared the cash. Here debit total is, that is 2,25,000 plus 2,27,200. 2,27,200. 2,27,200. So cash is closed. So this is all about the solution of one problem where all partners become insolvent. That is dissolution by operation of law. Thank you for watching this video. In the next video, we will cover one typical problem relating to piecemeal distribution. Then we will complete the partnership accounts. So don't forget to like and subscribe the video if not subscribed, and also share the video to all of your friends so that everybody will be benefited.